XIRR. Particularly in your mutual fund investments, XIRR is very relevant because a lot of us don't invest lump sum in mutual fund. We do SIPs. So taking that session forward, today we are going to be talking about a very important thing where how do you screen mutual funds? Say if you have to invest in mutual funds, then what are the qualitative parameters? What are the quantitative parameters which you need to understand? A key terminology of mutual funds, and how do you understand past performance, and how do you make a mutual fund portfolio which will have benchmark beating returns. So with this, I start today's webinar and I welcome the Finnovate team. Like last Wednesday, we have Sagar Maheshwari, who is going to be joining and leading this webinar today. Sagar has more than a decade of experience in financial services. He's trained more than 5,000 people in financial planning, and he's handled assets upwards of 400 crores. So welcome, Sagar. And also I have the rest of Finnovate team who are always the behind scenes warriors. Welcome, Sakshi and Pranav, because of whom you all are a part of this webinar today. So they do a lot of effort in terms of giving us a platform where we can take financial literacy forward. So moving on, we'll start today's session. I'll just quickly take you through that what is it that we'll cover today. Today, it's going to be, again, one of the very crisp sessions where we, as I said, will discuss key terminology. So we will look at the different broad categories of mutual funds. We will look at ratios, which you need to analyze to understand the fund performance and shortlist funds for yourself. We will also understand what is the role of a fund manager and why is it important when you're selecting a mutual fund. We look at tools which you can use on your own to screen mutual funds. Say Finnovate has suggested you a recommended portfolio, but you should also be able to study that portfolio very well and understand the rationale why it has been created. So we will discuss the tools which you can use to select funds on your own. And we'll also understand that we, wealth managers or a financial planning organization, how do we construct an ideal mutual fund portfolio? So today there is, we are not keeping anything a secret. Everything is out there and it's going to be an extremely educative session. So I welcome each one of you to today's session. So moving on, Sagar, all over to you to kickstart yet another FinFit Wednesdays.
Thank you so much, ma'am. Good evening, everyone. So I think today's topic is very interesting. Mutual fund as a product has been, I think, the most popular product in the last 66 years, maybe 5 to 6 years, if not the decade. We have seen so many popular campaigns, even by the government, mutual funds and everything, and everybody has been rushing to, invest in mutual funds. So what we'll do is we'll try to make you understand various things about mutual funds, what you are doing right, what you might not be doing right, what to look at when you select a mutual fund. So before we start the session and dive deep into all these topics, what I like to do is we'll just run a poll, a small poll, and we would like to know, how do you choose a mutual fund as of now? What do you look at? What is your primary thing that you look at when you're selecting the mutual fund? Is it the best performing schemes based on the past returns? You go and see 1 year, 3 year, 5 year, 10 year returns. You ask someone. You look for the lowest expense ratio fund. Selecting the based on category, let's say equity, debt, maybe any other categories. There are a lot of online platforms which give you star ratings. You look at that, or maybe you can look at all of the above. We would like to make sure that most of the people participate.
So I guess, yes, we would really, encourage each one of you all to just participate in this poll, because we will understand that which aspects we need to pay more attention on. And we'll know, okay, as of now, how are you making decisions to invest in mutual funds?
Also, I think if somebody is looking at any other parameters, they can put in the chat box. We'll also get to know if anything is not mentioned here. So I think people have mentioned on chat also how much alpha it is generating.
Yeah.
Okay, we look at it. Okay, so we have the results. So 41% people said all of the above. There are 27% people who look at the past returns, 1 year, 3 year, 5 year. 10% are asking somebody. 2% are there who look at expense ratio. 14 people are just investing based on the category. And then there are star ratings also, 6% people. Great. We have somebody in people in chat also saying top three performance in the category first, second, third year. So yes, I think past returns a lot of people look at because those are the returns which we look at a lot of websites. So I hope everybody knows what these returns are. Are those XR or CAGR? We covered in the last session as well. The returns that are mentioned there, which returns the website show, right? So what we'll do is
In fact,
we'll
someone has very nicely said that they look at the alpha the fund is generating. So I guess alpha also would mean like they are looking at the past returns. And what is it, how is it performing versus the benchmark? So I guess a very good point on alpha generation.
great. So we'll move ahead. Yeah. So first of all, we'll just look at the mutual fund industry. The size mutual fund industry has been growing, as I mentioned. In the past, 5-6 years, it has almost, I think, doubled over the past 5 years itself. So AUM under, the asset under management of mutual funds in India as of now, approximately, I think, end of August is around 66 lakh crores, approximately, US $800 billion. There are over 2,500 schemes available in the market, which is the biggest challenge which people face. That okay, out of this 2,500 schemes, which schemes should we have in our portfolios? So the number of folios have grown to almost 20 crores. Folios are there which have been created. SIP contribution as of August has reached a whooping 23,000 crores, 23,500 crores actually. So earlier, I think the numbers were, very less. I think before COVID and even before that, I think 2-3 years, we were at maybe at 10, 12,000 crores. Now we have reached almost double of 23,000 crores, which is again a very, good input, which is also supporting the markets nowadays because a good amount of money is being, deployed by the domestic investors as well. And the number of SIP accounts also saw a significant growth, increasing from 9.61 crores from August to almost 9.61 crores from the 9.34 crores in just July itself. So in the last 1 month, this is the number of SIP accounts that have grown, right? So once we have understood the key statistics about the industry, what we'll do is first of all we look at the categories of mutual fund. So what we have done is not going very into detail about the uh, very particular categories. We have just looked at the categories from a very higher level. So let's say equity funds. So what we're trying to do is we're just trying to define the risk and return, so you guys understand what are the risk and return of various categories of mutual funds. So yes, first is equity mutual funds. I think everybody's favorite. People are just raving about mutual funds, and they want to invest in equity. So these are high risk, high return mutual funds, stable for only long term investments. So there are various categories under the equity mutual funds. We have large cap funds, mid cap, small cap, index funds, sector funds, flexi, multi cap, focused, various categories of fund. But all these funds combined together fall under the equity fund class. Now these, as you mentioned, are high risk, high return, and for long term investment. Then comes the debt mutual funds. So debt mutual funds, low risk, low return. So low risk, by risk we mean the volatility. So they are very low on volatility. Yes, the returns are also low but stable. So these are ideal for your short-term needs, your short-term goals. Maybe buying a car in the next 1 or 2 years. If you want to make a down payment of the home in the next 1 to 2 years, these are the category of funds. They invest in your corporate bonds, government bonds, money market instruments, liquid instruments. So all these are the debt mutual funds, right? Then we have a combination of both, a blend of high equity and debt, which basically, in a cover your some portion in equity, some portion in debt. So hybrid mutual funds, ideal for medium term goals. So usually hybrid mutual funds again have two categories broadly. One is the equity-oriented hybrid mutual funds, which invest more than 65% of the amount in equities. And then we have debt-oriented mutual funds, which invest more than 65% of the amount in debt-oriented schemes, right? So these are three main categories. And the fourth one, which is a balance advantage category, a blend of all, which has debt, equity. It changes the equity allocation based on the market conditions, very actively managed. The equity allocation can go anywhere from 20% to 80% in this kinds of fund. So these are the four major categories where we have seen people investing also and are good for your goal planning as well, right? Moving ahead. So now what is important, right? So important is knowing your risk appetite and investment horizon plays a crucial role, right? So when you select the category, so a lot of people said this, select the category of the fund. So when you select the category, what matters more is you should know your risk appetite, your investment horizon. By investment horizon, we mean the goals. So when are your goals coming? So we have seen a lot of times people make the mistake of keeping their money invested in equity funds, even when their goals are in next 1 to 2 years. We even seen people have money in equity funds when even the goal is coming in the next 2 to 3 months. So they were investing in equity funds, but still they are continuing to invest in equity funds even when the goal comes near. So you should really assess your portfolio, assess the category of fund that you're investing in based on your risk appetite and your investment horizon, right? Next is the riskometer. So I think most of the people would have seen this riskometer, wearing on various websites. It is mentioned even in the fund fact sheet everywhere. Now SEBI has also mandated it to mention what is the risk in any of the categories of the mutual fund. So there are broadly 6 to 7 categories, 6 levels basically. So we have low, which low risk. You can say your liquid funds are kind of a low risk, which are very short duration, come in this category. The risk is low, usually the returns are also low. Low to moderate comes your debt funds, your conservative hybrid funds come in the moderate category. Then you have your moderately high risk fund, your balance advantage funds or aggressively hybrid funds that we looked at. Then high to very high comes your equity funds usually. So equity funds, maybe large cap funds or some aggressive hybrid funds can fall in the high risk category also. And in the very high, it would be your mid cap funds, small cap funds, your sector funds, thematic funds. So all these funds come under very high risk category. So when we say low risk, yes, that usually risk and reward is inversely proportional. Low risk means, sorry, they go hand in hand actually. Low risk means low reward. High risk means high reward. Okay. So with low risk, yes, the returns will be a little lower, but with high risk, you can make higher returns also. So we always talk about returns, but always know that with higher risk, the chances of losses are also higher. So you need to manage your portfolios according to your risk appetite and your investment horizon. Okay. Moving ahead. So what we'll do is we look at the key ratios. So a lot of you participated and you mentioned that you look at a lot of ratios. So what we have done is we have tried to capture some of the important ratios which are there for mutual funds. Okay. So first of all, we have we look at the quantitative parameters, which is the rolling returns. So how many you have heard about rolling returns? Can we know how many of you know about rolling returns? Yes, no. Have you heard about rolling returns?
Few participants have raised their hands that they have heard about rolling returns. I think you all can even type in chat if you all have heard about what is rolling returns. And I
If
guess,
we can
Sagar, if
run a
we
quick
can
poll.
do that exercise also, can we tell people basis the return, which fund will they select?
Yes, yes, we'll do that.
Before we actually explain what rolling returns is, I think it's going to be very insightful for people.
Yeah. So I see a lot of people saying no. Yes. So rolling returns, one of the very important factors which should be considered, but is not known by a lot of people. So we'll understand this point in detail, because what we have realized is it is one of the most important factors you can consider, while considering a fund. And majority of the investors don't even know about it. No, they have not even heard about it, right? Next, what we will cover is, so rolling returns is one. Then we look at the beta. So what is beta? We look at the Sharpe ratio, Sortino ratio, risk reward ratios. risk towards scatter plot, basically the capture ratio, and finally the expense ratio, right? So rolling returns. So just I'll give you a brief definition. We'll then go to the example which Nehal ma'am was mentioning. So rolling returns are annualized average returns for a period ending with the listed year, right? So rolling returns are useful for examining the behavior of returns for holding periods like those experienced by the investors. So what it means is rolling returns are those returns which you actually experience. Okay. So let me take an example. So imagine you are tracking the fuel efficiency of your car, right? Now, when you do the fuel efficiency, if you just take one trip into consideration, right? If you're just taking one trip into consideration, it might not show you the right fuel efficiency of your car. So let's say today you went from, Pune to Mumbai. You went through the expressway. There was no traffic. You left early. It was very smooth, breezy. You drove, at a very good pace, and you reached maybe Mumbai in 2 to 3 hours, right? And you see the average of your car, and maybe it is showing, a very good number. But when you're coming back, let's say there was very heavy traffic, or maybe next time when you mentioned you went, it was very heavy traffic. You found, the whole expressway was jammed. You went on a weekend, and then on that day, it might not show you the average might be very bad, right? So similar cases with the mutual funds also. So in mutual funds, the 1 year, 3 year, 5 year returns that you show, that you see are like the one or two trips that you might be taking, or for calculating the average of the car. They are very much impacted by the recent performance of a fund. So we say that actually your 1 year, 3 year, 5 year returns have a recency bias, right? So whatever is the recent performance of the fund, it boosts the last 1 year, 3 year, 5 year, 10 year performance of the funds. If we really look at closely the funds and you track them over a 6 month period, you will see if a fund has not performed for 6 months, it might be the top performing fund 6 months ago. If it is not performing now, it will start the 1 year, 3 year, 5 year, 6 year returns will start going up, right? So rolling returns are like taking not just one or two point to point returns into consideration, but a long, over a period of time, a lot of observations are taken into consideration. And by taking the average and the range of those, we try to assess, okay, what could be the average returns that an investor would actually observe, or actually experience through the time when they're investing through the funds. Okay, we'll just look at a quick example. So we'll just come to these later on. Yes. So what we'll do is, everybody, they need to do one thing. First of all, choose between fund A and B, and then between fund C and D. Fund A. So between fund A and B, which one would you choose? Right? These are, a lot of people mention 1 year, 3 year, 5 year, 10 year returns. A very popular metrics that people look at. So 1 year, 3 year, 5 year, 10 years. This is the performance of fund A and fund B. So which one would you choose? And similarly for fund C and fund D. So you have to choose two funds, one from A and B, one from C and D. Just by looking at the returns, which fund would you choose? A lot of people just look at the returns, we go and we check the returns of the mutual funds. So which one would you choose? In the meantime, you're choosing the funds. A very important disclaimer: any fund names or anything that you see in the presentation today are not an investment advice, is not a recommendation. We might be using some examples just to show you, how different funds have performed, but it is not at all a recommendation for you to invest or choose those funds. Please do your own due diligence, your analysis, or contact your financial advisors to, invest in the right funds. So some people are choosing B and D, some are choosing A and C, some are choosing A and D, some are choosing B and C. Great. So
Yeah, I think
please hold
we
on to
can
your thought.
publish. Yeah, we can publish the results also. but a lot of people have given different answers.
Okay,
So I
so we
guess
have A and C. A lot of people have chosen A and C. B and D also. So 60-40 in both the cases is the ratio, right? Great. Now we'll also look at another matrix, which is the rolling return. So this is how usually a rolling return analysis would show. It will show you your average return, a median return, maximum, minimum, what percent of the times the fund has given negative returns and in which range. So now based on this, looking at this analysis, which fund would you choose? Fund A or fund B? Fund A or fund B? Can we just run a poll, fund A, fund B? We'll just see. I think majority of the people are replying with B. So which one would you choose? You would have a poll, fund A or fund B? Fund B, fund B. We are seeing a lot of fund Bs.
someone is saying that they cannot see the slide fully. I think they'll have to go in their laptop or mobile, just click that icon of full screen.
Okay, we'll see the results, what people have chosen. So 80%, almost 80% people are now choosing fund B. Great. So from a 60-40 split, we have now moved to an 80-20 split, right? So one thing which you would have noticed that, this was the exact example. Compared to a point-to-point return, the above is the rolling return analysis. So it shows you so many data points, not just one data point. Just for the returns also, you see so many data points, right? Now, just to reveal the funds, so these are the funds, right? So people were selecting, I think, A, and once they selected A, then they selected, D. Some were selecting B and C, right? So at a point of time, you are selecting JM FlexiCap fund, then you are selecting Parag Parikh FlexiCap fund. Now, let me tell you, these, returns, the point-to-point returns that we have taken are just 6 to 8 months apart. So 6 months before, the first table was showing as 1 year, 3 year, 5 year, 10 year returns. Then 6 to 8 months later, this was the 1 year, 3 year, 5 year, 10 year table that was showing for these two funds. Now, for a lot of people, the fund changed. So if let's say we say that you should review your portfolio, they selected JM FlexiCap because maybe Parag Parikh was showing a negative, 7% return. It has just gone negative, not doing that well. 10 year में तो almost same ही है, but अभी negative है. Maybe another fund is not good. Whatever the reason might be, right? But just maybe 6 months down the line, they again go and review. They say, oh, it is showing now 18%. The 10 year is also good, right? So now in this category, it becomes very difficult, and you might change the your choice. But if you look at the rolling returns, I think we saw clear winner, which was the Parag Parikh FlexiCap fund, right? Because you see the average returns are also good, the minimum is also good. Minimum, it's better than the JM FlexiCap. The maximum is almost the same. When we look at the overall return distribution also, so between 0 to 8, Parag Parikh has given less returns. 8 to 10 also it has given less returns. 10 to 12 it has given less returns. Even 12 to 15 it is less. Where it outperforms 15 to 20. Most 50% of the times it has given around 50% returns. Sorry, more than 15% returns, right? So now this gives you a very good analysis, more data points to take an informed decision rather than just looking at a recency bias or a recent performance upcycle for one fund or the other. I hope everybody understood the difference between point to point and rolling returns. We'll also look at one more example. So this is how you would see another way of looking at rolling returns. So this is for a particular fund which So rolling returns, basically, I just missed one slide, so I'll just go back to that. So there are three main things in rolling returns, right? One is the holding period. So holding period is basically your investment period. So what investment period you are targeting? So let's say 1 year, 3 year, 5 years. So this holding period is based on the category of the fund. So let's say usually debt funds, as you mentioned, are for your recent or maybe your short term goals. So for that, you would look at a holding period of maybe 1 year, 2 year, 3 year, right? But for long-term goals like equity mutual fund or something, you would look more of a 3 year or 5 year returns, right? So holding period is one. Then is the rolling frequency. That okay, at what frequency are we looking at the returns? We'll look at every day. So let's say if we take an example of 5 year rolling returns. So we look at okay, exactly if you invested on any day and you held the portfolio or a fund for exactly 5 years, and then again you invest on the next day and look for 5 years. So like this, you'll get a lot of, you'll get a total frequency distribution. You'll see so many, data points to compare. And then is the time period. Okay, along what time period you are, measuring the performance? Is it the last 5 years, last 10 years, right? So typical rolling return. So let's say I'll show you this. Now going to the slide. So this is basically over a period of 10 years, we look at a fund. So what this fund has given returns over a 520 days means 2 year holding, 780 means 3 year holding, and 1300 means 4 year hold, 5 year holding. So we typically take in a year that there are 260 working days. So over a if there are 260 working days, so 520 means 2 years. So over a 2 year period, what were the average high and low? Over a 3 year period, what were the average high and low? And over the 5 year, what were the average high and low? So if you look at this, that yes, maybe for a short period of time, this is a pure equity fund. Okay. So if you're looking at a very short period of time, you would see, oh, this fund has given negative 10% returns also. But when we increase the time horizon, if you see the negative returns are almost 2%. And if you've held this fund for 5 years, so at any point of time in the last 10 years, you would have invested in this fund and you held the fund for minimum 5 years. Your minimum return, if you are very unlucky or you invested at the wrong time, would be 6.58%. And that is also at the time of COVID when the markets fell down drastically, right? So if you see the chart, also the blue line, around the 2020 mark, it is the lowest, right? So when we say, equity funds are for long term, why we say it is for long term? This is the reason that it might happen that even if you have held a fund for more than 3 years, it might give you a negative return. There are chances, there are funds we have seen in different categories, which even at 3 year, holding, give you a negative return of maybe 8 to 10% also, right? And this is on CAGR basis, right? CAGR or XIR basis, right? And then you look at the average return, high returns, 47. So if you see in 2 years, the high is also very high, 47. 3 years, 30. 5 years, again normalizes to 24. And the average, 18, 18, and 17. So now this gives you a better idea that, okay, you might be looking at 1 year, 3 year, 5 year, 10 year returns, and it might be showing, okay, in maybe 5 years, the fund has given you around 25% returns, 30% returns, right? Which is the case as of now. If you look at a lot of funds, 5 years, returns would be very high, because if in for the last 3 4 years markets have been going in one direction. And I'm telling you exactly, in 6 months, when we complete 5 years from COVID, you will see in March of 25, the returns are at the peak. If the markets are at the same levels, the returns are at the peak, because what they'll be showing you exactly from the time of COVID, if you would have invested, this is the returns that you had made in 5 years, right? But it doesn't consider the time in between. So rolling returns shows you this. Another table that is there and below this, if you look at it, that this fund has given negative returns 0% of the times. This is for a 5 year range. Okay. So if we saw that also, that okay, it's 6.58. So for a 5 year range, obviously it's below zero, there is no. Even between 0 to 8%, it's just 0.6% of the times, right? So we are looking at almost 1300 data points. So 1300 data points, out of which 0.6%, less than 1%. So not even 13 instances have been there, or 10 instances have been there where this fund has given between 0 to 8% return. Only 8 to 10 instances. Between 8 to 12%, 3.84%. Now that the game changes. Between 12 to 18%, almost 52% of the times. And above 18%, 43% of the times. So what this shows you is that when we say, that, a lot of times we do calculations, we take an assumption of returns of around 12%. Why we do that is because we know over a long period of time, if you're investing in equity funds, there is a very high probability that you will get an average return of 12%, which can be seen in this data range as well. That 95, almost 95% of the time, 95 to 96% of the times, this fund has given a return of more than 12%, right? So this gives you a very broad and a long-term view or a detailed view about the performance of the fund rather than just looking at 1 year, 3 year, 5 year returns, right? Any questions here? Anybody has any questions?
So just to simplify, what is point-to-point return, which lot of time investors look at while creating a portfolio. So if you were to look at March of 2020, when the COVID dip happened, okay, so anybody invested in March or April, where it was like a lowest point, and when if they will look at today the value, they will see a very phenomenal return because it is point to point. I invested on the dip day, and from there, if I look back, in now 2024, if I look back the last 4 years return point to point, it will look very good. But if same person would have invested at some another point of time, and he would have looked at the return today, the same fund, but the return would have been very different. So point to point, looking at the past performance, 1 year, 3 year, 5 year, it can be very misleading. And so a better way to select a fund and how do you evaluate is looking at the rolling returns. This is what Sagar was trying to say, and he gave you different examples on, the days for which you need to look at rolling return. And if you can see, like you exactly know, okay, if you are investing in a particular fund for more than 3 or 5 years, then what is the lowest the fund has gone? Say in it's 6.58. What is the highest? It's about 24. Okay, but what is the average return on different periods? That is also given. So this is a much better way to shortlist a fund than just looking at point to point return. So one thing, if you want to take away from today's session, is that you'll stop looking at point to point returns when you are shortlisting a mutual fund for you. Or if you have any advisor and he's presenting you some mutual funds to invest and he's giving you these are 1 year, 3 year, 5 year returns, then this is not what you're supposed to look at. You ask for the data of rolling returns.
Exactly. So rolling returns, one of the most important parameters when you are selecting the mutual funds, a very detailed analysis of the returns rather than the point-to-point returns, as we just discussed. Okay. So since I think, okay, people asking if there any site, yes, we will show you the tools at the end. We'll cover that as well. Okay. Moving ahead, we look at some other parameters which we discussed. So we look at the beta. So what is the beta? So beta measures the risk of the portfolio against the benchmark, right? So in the last webinar, we had also discussed about benchmarking. So first of all, it is, as we have discussed, it is very important to know what is the right benchmark for your overall portfolio or for a particular fund. And then you compare the beta of the fund with the benchmark, right? So beta is basically comparing the returns of the volatility of the portfolio with the benchmark. And it will show you that, okay, what is the beta. So ideally, we say that a beta less than 1 signifies that the particular security is taking less risk or is less volatile than the benchmark, right? Which is a good thing to have. If the security that you have is beating the benchmark in the risk also adds a lot of, security in a portfolio as well. Okay, so beta, lower the better. Higher beta obviously suggests that the fund or the security is taking higher risk than the benchmark. So that should also be supported by higher returns. If it is not giving higher returns, it's not a good security. Then we look at Sharpe ratio. So it's a measure of risk adjusted returns. It tells you how much returns is being generated by a fund for every unit of risk that you are taking. So for every unit of risk that you take, if you take 1% extra risk, how much return is the portfolio or the fund is giving to you, right? So whatever is the risk, your return should be as per that. Additional risk, how much returns you are able to generate additionally. So usually a Sharpe ratio of 1 is considered to be very good. Anything higher than 1 is again very good. Lower than 1, it's not that bad, but it should be closer to 1. The farther away from one it is, the fund is not giving you good risk adjusted returns, right? Ideally, one and above is very good. Okay.
So just to simplify what Sagar just mentioned, that if I take higher risk, I can get higher return. So he had shown one slide on riskometer, that low risk, low return, high risk, high return. So I can take higher risk and generate high return. But as investors, we want to invest in a mutual fund, or we want to select a fund manager who's so good in decision making in his research and all, that he is able to generate a higher return but still controlling the risk. Okay, so the key concept to learn here is the risk adjusted returns. So what return I am getting for what unit of risk I am taking. So if I am earning a return of say 1, but I'm taking a risk of 1, then the risk return is equal. But am I earning a return of 1 with a risk which is much lower? Okay, so that's the reason the higher the Sharpe ratio, the better. That means if the fund manager is taking 1 rupee of risk, he's generating, say, a return which is more than 1. So that's the reason we need to look at funds which have high Sharpe ratio. That means the fund manager is able to give you a alpha or a higher return, but still he is able to control the risk which is there. So it's not high risk, high returns. It is higher return, but by controlling the risk.
Exactly. So a lot of times what we have seen is people just talk about returns, returns, returns. We have also talked about, rolling returns, whatever the kind of returns may be. But people forget to talk about the risk. So these parameters are very important to judge, okay, what are the risk adjusted returns? How much risk am I taking, and am I getting rewarded for the risk that I'm taking or not? And is there a way that I can control my risk and still generate good returns? Okay, which is possible. Then another version of or a subset of Sharpe ratio is the Sortino ratio. So what Sortino ratio does is that it removes the difference of the harmful volatilities in the fund. So when we talk about volatility, it considers the highs and the lows both. So in Sharpe ratio, when we consider volatility or the risk of going high, when the fund is going high, and low as well. But in Sortino ratio, it just considers the low when the fund is going down. And in that case, is the fund giving you good risk adjusted returns or not? That if, let's say, a fund is going down by a good amount, is the fund manager able to beat the market and control the risk and still able to generate? Or maybe the fund is going down less than the what the market is going. Okay. So volatility, but only for the negative side, not the positive side, is the Sortino ratio. Again, higher the better, more than 1. Sortino ratio gives you a better risk adjusted returns even when the markets are not doing that well. Okay. Or there's a huge volatility in the market, still your portfolio is giving you better risk adjusted returns. Right. Next, we look at the up capture ratio. So again, a very important parameter to look at, knowing how the fund will perform when the market is in an up cycle. So let's say if market is going up by 100 points, how much of that 100 points or the upside the fund is able to capture? Is it going up 100 points? Is it going, down by, it's going up by only, let's say 97, 96, or it is outperforming the market and, capturing, 110%, right? So let's say fund gives you, the market is giving you 5% returns, the fund gave you 5.5% return. Versus a fund, when the market is giving you 5% return, the fund is giving you only 4.5% return. So what percentage of the upside the fund is able to capture for the market? So again, higher the better. Down capture ratio considers the downward trend of the market. So if the fund is going down by, let's say, or the market is going down by, let's say, 100 points, how much the fund is going down, how much of that negative, downward trend the fund is able to capture. So this is lower the better, right? Obviously, if the fund is going down by 100 points and the market is going down by 100 points and your fund is going down by only, let's say, 50, 60 points. So it has protected the downside of your portfolio, which is very important to control the risk of the portfolio, right? So up capture, higher the better. Down capture, lower the better. But now let's take an example. Okay, we have two funds again. So there is an up capture fund has an up capture of 110. 0.87. So means if, let's say, market goes up by 100, the fund is going by 110. If market goes down by 100, the fund is going down by 95. right? Compared to a fund where the market is going up by 100 and the fund is going up by 92 only. But the down capture is when the market is going down by 100, the fund is going down by 77, right? So which fund do you think is doing better? The first one or the second? Which do you think is doing better?
Second one. Some people
Some
are
is
saying
some are
second.
saying second, some are saying
Yeah,
first.
yeah, we can have a poll also for this quickly if required. Yeah, some people are saying second, some are saying A, first one. Yeah, I think a lot of people have already answered. So we can just take this forward.
So now let's say, so how to analyze this is basically by looking at the capture ratio, the overall capture ratio. So the capture ratio is basically up capture divided by the down capture, right? So let's calculate it for both the funds. So for fund A, 110.87 divided by your 95.45 gives you a capture ratio of 1.61, right? That is for fund A. Similarly, if you look at for fund B, so 92.67 divided by 77.25 gives you a capture ratio of 1.2 almost, right? So which means that fund 2 is doing better. Now, why is it doing better? So let's take another example. Okay, so let's say there are two portfolios. Both the portfolios are at 100 rupees today. The market falls down to 50%, right? So let's say the fund, A also falls down by 50%. And the fund B is falling down by just, let's say, 20% or 30%. It comes down to 70, right? So fund A is 50, fund B is 70. Now let's say the market goes back up, there's a V-shaped recovery, the market goes up and it again goes up by 100%. So the fund A from 50, if you get 100% returns, where will you reach? You'll reach at 100 again, right? It went down to 50, came to 50, again 100% returns, you came back to 100. But for fund 2, if it is able to capture even 50% of that upside, so 50% returns even if it is able to generate, so which means 35, the fund 2 will be at 105, right? So capturing the downside or the downside is very important, controlling the downside of the portfolio. Okay, I hope everybody understood this. So moving ahead.
Yeah,
So
I think
capture.
we should just like harp a little on this. On face of it, the fund one, which looked very good because if market is going up by 100, the fund is becoming 110. Okay. And when the market is coming down, say it is, going down, it's capturing about down is 95. Okay. So on face of it, it looked so good. And the fund two, it didn't look good because in the up capture, it's not going above 100. It's not capturing the entire, or it's not going up. It is only going up by 92. But what is happening is on the downside, it is not falling. Say if market has gone down by certain points. It's not falling as much as market, it's falling much lesser. And so whenever the reversal is happening, the fund too is able to perform much better. So these two are extremely important parameters when you're shortlisting funds. And you need to see at the overall capture ratio. So we just discussed how we look at the overall capture ratio. So I guess, Sagar, maybe with one or two examples, if we can clarify this, because this is a little technical, but once people understand, they can make
Yes.
better decisions.
So as I mentioned, when we look at any fund, the how the fund is performing in the downside of the market is very important. Controlling the risk. So we have to always make sure that the risk of the portfolio is controlled. We see a lot of portfolios, investing 100% into equities, 90% or 80% into mid and small caps, right? But you have to also look at when the markets will go down. How will your portfolio go down? Now see, when you look at these numbers, it is very easy to comprehend कि अरे हाँ ठीक है ना, 50 ही तो डाउन जाएगा, मार्केट ऊपर जाता ही है, हमें पता ही है, आजकल सबको पता चल गया है, मार्केट इज गोइंग टू गो अप, हमने कोविड भी देख लिया, हो गया. But when your portfolio actually goes down to that from 100 to 50, so imagine you have a portfolio of 1 crore and it falls down to 50%, comes down to 50 lakhs. How would you feel at that point of time? What would be your emotions compared to a portfolio which is going down by, only to 80s or 70? Right? What would be your thought process at that point of time? Will you, how would you sell the portfolio? What would you do? So looking at the capture ratio becomes really important. Now, how you can use this also? See, it's not that the fund one is really bad. It's just 1.16 and 1.2. The difference is small. So if you are a conservative investor, so your risk profile is not very aggressive. We talked about risk profile in the starting, right? So what is your risk profile? Always know that. So if you are somebody who is a moderate or a conservative investor, look for funds with better down capture rather than the up capture. And if you're somebody who's an aggressive investor, look for more up capture. And even if the down capture is a little higher, that should not matter. Right? So it totally depends on your risk profile also. Sometimes it depends on at point of time when you're investing in the market also. If the markets are down and you want to select a fund, you can look at fund which will capture a good upside of the market. So let's say at that point of time, fund A might be good. But if things are looking a little hazy, market valuations are high, where the market could go, we don't know, it can go up, down, chances of down are also good. Fund B might be a good option, right? So what needs to be looked at is the overall capture ratio, how to, what risk adjusted returns or how the portfolio or the fund will capture the volatilities of the market. Because this is what impacts your emotions, and controlling your emotion at such point of time is very, very important. Right? Next, and another important thing is expense ratio. Very,
One second, what I have done now while you were talking, if I can just get the rights to share my screen, I've taken one example of how returns look, because I guess in numbers, people will find this very easy. So I've just put like, say if your portfolio value, or say if you bought a stock of 100 rupees, okay, and market fell by 50%, okay, and this particular stock also fell by 50%. Then the stock price became 50. 100 has become 50. Now there is another mutual fund or another stock where again your investment is 100, but iska down capture. Okay, it is not fallen. If market has fallen 50, it has not fallen 50, it has fallen only 30. So what happened? Aapka 100 रुपए का जो stock price है, it is down to 70. Now what happens? Now a good year came. So market went up by 100%. तो ये जो अच्छा fund है, वो तो market को mirror कर रहा है. So now this fund or this stock also went up 100%. So 50, the stock went up by 100%, it became 100. But the other stock, which didn't fall so much, like it didn't fall equal to market, it fell less than market. तो उसकी price 70 थी. अभी ये 100% नहीं बढ़ा, market 100% बढ़ा, but this stock did not go up, say 100%. It went up only 90%. Okay, still, if you see 70 का जो value है, fund value है या जो stock price है, it went up by only, it captured only 90% of the move. Okay, so it has become 113. So now this is so simple. So when do you make very good returns or when do you make money? When you earn more in the upside. अगर fund manager अच्छे market में बहुत अच्छी return दे रहा है, तो वो तो मार्केट अच्छी है, सब दे रहे हैं. But if a fund manager in the bad market can protect your downside, that means your fund value is not going down that much. And when the time is good, if he can capture 80-90% of that upside also, still you will get better return. So understand how do you judge a fund manager, or when you are investing, with this example, you're very clear कि भाई मेरे को risk control करना है. If something falls less than the market, and when market is in a good time and it goes up a little less than market, still overall you will make much more return. So as investors, what is your one thing which you have to remember is that you should not lose money. You have to control the risk and the downside.
So as you saw in the example, just by controlling the downside by a little, an upside of almost 30% was created. 30% is a very huge amount, which, just by protecting the downside of the portfolio, a portfolio was able to give you better returns, right? So yes, returns are there, but how, you behave, that also will really help you in controlling your returns and the emotions, right? I hope this is clear to people. Great. Moving ahead, so expense ratio, it is the fee that a fund charges to manage your money. So yes, somebody is managing your money on your behalf. So the mutual fund company charges fee expense ratio, which is there in all the funds. Yes, it should be looked at, but it's not the, one of the major concerns when you look at the expense ratio, okay, or the expense ratio of a fund. So see, whatever returns you see at, whatever returns we have been discussing or you see anywhere, all those returns are adjusted of your expense ratio. Okay. It is not that the returns that you see in that you have to adjust the expense ratio. Expense ratio is always adjusted. Your returns are after adjusting all the expenses, right? So we have seen that a lot of people focus on just the expense ratio. यो इस फंड का expense ratio ज्यादा है, इसमें हमें नहीं करना. But you take an example. If a fund with an expense ratio of 2% is giving a return of 20%, whereas a fund with an expense ratio of maybe 0.5% is just giving you 15% return. Now, which fund to choose? The expense, if you just look at the expense ratio, you might go with the second fund, but actually fund one is doing much better because even after the expense ratio, it is able to deliver you a outperformance. Expense
The
ratio again
slide
is
is not changed. I think we are still at that capture 1.16.
yeah, expense ratio just here at the bottom. Yeah. So another way of looking at expense ratio is, so when we meet a lot of clients, what I tell them is, so in any place, you look at, doctors, you maybe look working in a company, anybody who's performing well will get paid well, right? So if a fund manager is doing well, they might charge a higher expense ratio also. So you should not shy away from the expense ratio or paying the expense ratio if the fund is doing good. Yes, if a fund is not doing good and charging a higher expense ratio, you should not go for it. When you can look at expense ratio, let's say two funds are very comparable and you've done all the analysis, all these parameters that we discussed and they're coming, almost 90, कहते हैं ना 19-20 का फर्क है. Then maybe you can look at an expense ratio and see, okay, whichever is the lower expense ratio fund, you can go for that. But ideally, expense ratio should not be a primary point to be considered when selecting a fund. It should be the last thing that you should look at when you are selecting a fund. Right?
I think some people have also written about the regular funds and direct funds, direct plans. So we will discuss what is the difference between regular and direct plans. And it is a myth that I invest in direct plans, so I'm saving something, so the direct plans expense ratio is lower than regular plans. So I will make very high returns because I'm saving that little bit of money. So that is also a myth which people have. Today we will discuss that also. So we will discuss the difference. And is it true that if you invest in direct funds, you will have higher returns? Okay, we'll look at data and example to see that. Yes, Sagar.
Yes. And another last point, in quantitative parameters which we look at is the risk reward ratio. So again, a very important parameter, that what is the risk a fund is taking compared to the benchmark or the category as a together, and where does it fall. So usually what we do is, so we plot the funds, based on the, left hand side, you see the returns are plotted on the bottom axis. So x axis we have that, and the y axis is this, right? So low returns. So on the below you see the volatility, and on the left hand side you see the annual returns. Now based on that, all these funds are plotted. When we plot the benchmark, so let's say the benchmark or the category average falls in between, and that divides the whole chart into four quadrants, right? One is low risk, high reward. The other is high risk, high reward. Third one is low risk, low return. And the fourth one is high risk, low return. So what this tells you is that the funds falling in the high risk, high return category are taking higher risk than the benchmark and are also able to produce higher returns, right? The funds falling in the low risk, low reward are taking lower risk than the benchmark and still able to generate much higher returns than the benchmark, right? Similarly, low risk, low reward, lower risk, low returns. And there might be some funds that which are taking higher risk but are generating lower returns, which should be avoided in your portfolio, right?
So I guess a lot of people would have invested in the Franklin Templeton credit risk funds. Okay. So it was a debt fund and it was generating high returns. So a lot of retail investors saw the 1 year, 3 year, 5 year returns of those debt funds and they invested in that. And some problems with some corporates happened and the debt fund had to be freezed and it took a little time for investors' money to come back. So what was happening? The fund was giving high return, but it was taking much higher risk. Okay. So you should not look at return without the risk. Okay. If you're going to a debt fund, the first criteria is that the risk should be low because it is debt. In the debt, the first criteria is that will I get my principal back? How soon can I get my principal back? And what is the return which I can get by not taking too much risk? Okay. So we should not look at a return just standalone. Return with the risk. And like Sagar rightly said, the best thing is to be in this category where the risk is low, but the return is high. So funds which are giving you return higher than the benchmark, but at a risk lower than the benchmark. This is the best, category of funds to be in.
So again, coming back to your risk profile. So yes, this fund is ideal for everybody, no doubt about it. Everybody, anybody can ideally invest in this fund because it is taking lower risk and giving you higher returns. But these funds are also not that bad. They are giving you higher returns, but with high risk. So it depends on your risk taking appetite. If you are an aggressive investor and you are okay with the volatilities and the risk, you can consider these funds also. These funds should be totally avoided because they fall, taking much higher risk than the benchmark. If you see, almost, benchmark is at 16.5, 16.6, and they are taking around 18%, almost volatility, and the returns are hardly 8 to 10%, right? So much higher risk and much lower returns than the benchmark. Not able to beat the benchmark even by taking higher risk. And then comes the low risk, low reward funds, which can be good for people who are looking for, low risk. They don't want to take much higher risk. Their risk appetite is very low. They come under the moderate or conservative category of, risk appetite. You can consider these funds, but yes, it should not be very low, and it depends on the category of the fund as well. So all the parameters that we looked at, they cannot be looked at just as standalone. You have to look at all of them as a whole, and then you can, consider which funds, which category, where to invest, what to do. Okay. So this you can, so this analysis ideally should be done for similar category of funds, right? So if let's say comparing, let's say this is a flexi cap funds. So these are all the flexi cap funds. So there is a flexi cap fund which is doing, coming this in this quadrant. Three of them are coming in this quadrant, and two of them are coming in this quadrant. So you can avoid these, maybe consider this, but yes, definitely you can invest in this, looking at other parameters as well. Okay. Yeah. Moving ahead. One second. Annotations are not. Okay. So now that we have looked at the quantitative parameters to look at in a mutual fund, we'll also look at some qualitative parameters. So a lot of times we see people or investors just looking at quantitative parameters. They might look at one, two, three, or maybe they might look at all of them. But what matters also is the qualitative parameters, right? So we say them as hygiene factors for a mutual fund or mutual fund house. So what all things you should look at when you're considering some qualitative or hygiene factors? So first thing is management of the asset management company. Who are the people who are managing your money, right? Who are the people who own the asset management company? So asset management companies basically are HDFC Bank, or sorry, HDFC Mutual Fund, ICICI. You have Mirai, Quant, lot of them. We have more than I think 40 mutual fund houses. Who is managing the uh, company? What is their pedigree? Where do they come from? What is their track record? All those things. Fund manager and his experience. The person who is going to manage your fund, who is going to take all the calls on your fund, what has been his experience, where has he worked, what kind of returns he has generated in the past, what has been his alpha, right? Those also need to be looked at when we are selecting mutual fund. We have seen a lot of times that in a lot of fund we have seen this case also, that when a fund manager leaves, the performance of the fund goes down drastically, right? So you need to look at, okay, this is a major, you can say a point of review of a fund, that okay, if a fund manager leaves, a new fund manager comes, who is the fund manager who has changed, how has been his experience, which all kind category of funds he has managed, and things like that will help you in taking a call on should you continue to invest in this fund or not. Okay. What is the style of investing? How does he invest? Is he sector agnostic? Does he focus on some sectors? Does he follow top down approach, bottom approach? Various kinds of things. So how does the fund manager invest? Is he very aggressive? Is he focused on generating high risk, high? Is he managing the fund based on high risk, high reward category, or is he looking at low risk, low reward, or maybe low risk, high reward? What kind of how he's trying to manage the fund? What is his style of investing? Another important point is look for and avoid portfolios with bad stocks. Some stocks which are not doing good. What that means is some fund manager is investing in a company which is very new, or let's say which doesn't have a good track record, or fundamentally is not good. And he's just taking a high risk, investing in that stock, or taking a high risk, which means that the maybe the style of investing of that fund manager is high risk, high reward. It might work out, it might not work out. Maybe he's investing on a turnaround story. It might turn around, it might not turn around, right? So it is up to you. You need to look at the stock portfolio of the mutual funds also. Is it investing in the some companies which are not good? Avoid those funds. We usually recommend that invest in funds which have a proven track record, where you can do some analysis. At least 5 years of time period is there, where a fund has shown you some returns, shown you some performance, it has gone through some cycles of the market. Yes, some exceptions can be made in case the fund manager is good and the portfolio is good, right? So a good fund manager with a good track record comes up with a new fund and maybe a good portfolio, yes, you can consider that. But usually we recommend that a fund which has a proven track record, go for that. Try to avoid the noise or the fads or the FOMO of some fund which is very new, some new fund which is coming like a abhi to yahi fund chalega, nothing like that, right? Always focus on a proven track record fund for the stability of a portfolio. Yes, you can take very small bets in maybe some NFOs which come. Also, please remember, NFOs are not equivalent of IPOs. We see a lot of people consider mutual fund NFOs as IPOs, that okay, we'll invest in the NFO, as soon as the fund list we'll book profits. Doesn't work like that. Okay, so mutual fund NFOs are very different. You have to consider all the things when you're investing in a fund. Okay, proven track record is ideal. Look at the size of the fund. What kind of a size of a fund it is? Is it managing way too many assets? Is it not managing too many assets? But that should depend on the category of the fund also. In large cap, it doesn't matter how big a fund it is. But sometimes we have seen in some categories, like, let's say a small cap or a mid cap, flexi cap, the fund size can matter, right? Where the fund is able to invest. Is the fund manager able to handle the kind of assets that are coming in? Are they able to deploy that properly? What is the size of fund? What is the size of the market? Where do they have enough opportunity to invest in or not? Right? And then, yes, the last but not the least, prefer funds with lower TER. We just saw that if the performance is the same, right? Yes, expense ratio can be looked at, but only as a last point when the perform or in all the parameters the funds are doing equally good, right? So we looked at, the qualitative parameters, the quantitative parameters. We also at the starting looked at there are 24 more than 2,500 funds in the mutual fund industry. Now, how do we choose the funds? So the biggest problem is the challenge is how to build a good mutual fund portfolio. So when you do this all analysis, you'll go, we'll show you the tools. You go, you analyze, you'll do this, that. You will come up with a, broad basket of funds, which might be anywhere between 15, 20, 30. Because if you depends on how many categories you analyzed, what all you did. So by doing all this on a broad, mutual fund base, you will come with a basket of mutual funds. Now the task is very important. How to build a good portfolio? Which fund should have what allocation? How to do that? What all things to consider while building a portfolio? I always feel a constructing a good portfolio is much more important than selecting the right fund. You might not have the best performing funds in the category, the top performing funds in the category, but if you have built a portfolio really well, kept the diversification good, asset allocation good, your portfolio might even be a portfolio which has the top performing funds in the category, right? So we look at some pointers that, okay, what all things to look at when you're building a portfolio, right? So how to build a portfolio? Let's go step by step. Okay. The first step is define your risk profile. Know what your risk profile is. Very, very important. We have been, I think, stressing this from the start of the webinar. Always know your risk profile. Where do you fall? Low risk, high risk, or in between. Then define your asset allocation as per your risk profile or the goals. Your risk profile might be aggressive, but if you have very short-term goals for which you need good amount of money, you should not go very aggressive into equities, right? So your goals matter. Always focus on your goals as well. We have seen a lot of times people are just investing, here and there, randomly doing a lot of things, but are not investing as per their goals. They think they are, but they don't. So it's like, you just sat in a car, you started the car and you started going somewhere, but you don't know what the destination is. The destination is your goal. So always know what your goal is and select your asset allocation as per the goal as well. This is very important. Maximum number of funds in a portfolio ideally should be 6. Maximum can go up to 8 at any point of time in your portfolio. We have seen a lot of people, they say कि they have 20-30 funds, but मैं तो 6 और 8, 6 to 8 funds में SIP कर रहा हूँ, right? तो मेरे तो 6 से 8 फंड. It is not how it works. You should always have total number of funds. Either you're investing in them actively or not, should not cross more than 6 to 8. See, mutual fund as an asset class or a product already diversifies your portfolio a lot. An average mutual fund would be investing in anywhere stocks between 30 to 50, 60 stocks. There are some mutual funds who invest in even 200 stocks. So if you just go on shopping of mutual funds and you buy 10, 20, 30 mutual funds, you will not be able to beat the market also at a point of time, because you have bought so many funds, you've almost become like a benchmark. Since you are also paying some expense ratio, you'll not be able to beat the benchmark. So a lot of times we see people, they say that mutual fund mein return nahi banta hai. Why it is not there? Because you are investing in too much. So yes, diversification is important, but too much of diversification leads to a reduction in your returns, and maybe your risk is still high. So you might fall in that high risk, low return category, right? So always have a control on the number of funds. Diversify. How do you diversify between the 6 to 8 funds? Diversify amongst AMCs, mutual fund companies, categories, sectors, right? All these things you can diversify just by building a portfolio of 6 to 8 mutual funds as well. You don't need to go on shopping of mutual funds. Ideally, from a single category, one fund is more than enough. Not more than two you should have in a category also, right? We have seen people who are investing in similar, they have 4 large cap funds, 5 mid cap funds, 6 small cap funds. हर साल मैं देख रहा था कौन सा फंड अच्छा कर रहा है, जो फंड का लास्ट 1 ईयर 2 ईयर 10 ईयर का अच्छा दिखा है उसमें कर दिया, एंड पिछले 5 साल से वो वही करते हुए. We have even seen people with funds who have funds around 80 to 90 funds in a mutual fund portfolio. Imagine. Even in a stock portfolio, we don't recommend more than 15 to 18 funds, 18 scripts or 18 stocks. But people in mutual funds also have 80 to 90 mutual funds. And they have no clue how their portfolio is performing, what is the XIRR returns, which fund is doing good, not doing good. So when you have limited number of funds, you can track them actively, you can build a good portfolio and gives you enough diversification as well. Focus on better risk-adjusted returns of the portfolio. Not just returns, but risk-adjusted returns of the portfolio should be good. Okay. You can follow a core and satellite portfolio approach as well. So what we do at FinnFit is that we divide a client's portfolio into 2 categories. One is the core portfolio, the other one is the satellite portfolio. So what does core satellite portfolio does is satellite portfolio is used for some tactical calls and rebalancing of the portfolio, right? So we might take some sector calls, some asset allocation calls, some asset wise call, debt, gold, whatever is doing good. So this can be maybe 20-30% of your portfolio based on your risk appetite. And then there is the core portfolio, right? Core portfolio basically is the funds which are there for long term. We are not touching them much. Yes, you continuously keep reviewing the funds. Once you have done a good analysis, it's a proven track record, continue with those funds for a long period of time. Only if there's a major change or major, activity in the fund, you can look at changing those funds, but otherwise no. So these funds help you in creating a stable, give a stability to your portfolio, and the satellite portfolio helps you in generating that alpha over and above the benchmark, right? So by doing this, you can divide your portfolio. You know, okay, which are core funds, which are satellite funds. Use them and manage them actively, and your returns will be good. Your risk-adjusted returns will also be good. Minimize the portfolio overlap among the funds. Very important. We see people, as I mentioned in the earlier examples, also investing in 4 funds of the same category, large cap. There are only 100 stocks in under the large cap, out of which maybe 50-60 companies are good. And majority of the companies are in mutual fund investing in those companies. So we feel कि मैंने 4 large cap fund लिए, diversification कर दिया, but when you see the overlap, it is among 60-70% of the portfolio is same. So what is the point of diversification? You're investing in the same companies.
So
right?
This is a very important point where people are missing out on the portfolio overlap. Okay, the only way you will be able to consistently, beat the benchmark and earn a superior return against the benchmark is when you are definitely diversified, but you're not overly diversified. So there's a fine balance which you need to strike. So if you are investing in funds with in many funds on similar categories, then what happens? Say if they have bought say 100 companies, you think you're putting in 4 funds, so you're diversifying your risk. But that 4 funds from the 100 stocks which they've bought, 60-70 companies are same between the all 4 funds. So 60-70% of underlying companies which the funds have bought, all the 4 funds have those 70 companies only. So what risk have you diversified? Because fund manager A, B, C, D, out of the 100 companies which they've selected, 70 companies are similar. Okay, so there is no, diversification which you did. In fact, there is too much of overlap. There's no point having 4 funds where 70% of their portfolio is similar. So it's very important to control this overlap. So you can only control overlap when you have different categories of investments and you have less number of funds. So it is a myth that more number of funds means better diversification and higher returns. It is actually the opposite. The less number of funds, because fund manager itself is buying so many companies. So less number of funds, the better it is. to control the overlap in the underlying portfolio. Yes, the MF companies declare their portfolio. We will show you where you can go and check the portfolio of mutual funds. That's very easy to get the portfolio of where the funds are investing.
Yes. And keep the expense issue under check. Okay. So now let's look at example of, let's say we build a portfolio. So let's say there are different categories of funds, 6 to 7 funds. 4 can be core, 3 can be satellite, thematic, that rebalancing amount, whatever it might be, right? Now we look at the different allocate, how to analyze a portfolio, what all things to look at in a portfolio also. So first is the asset allocation, right? And the sector allocation. So let's say this portfolio that we have built has only 72% into equities. But you look at another thing, that there is an exposure of 6% to foreign equities also. So total approximately 70 to 80% is into equities, and rest 20% is into debt, right? So the asset allocation becomes 80-20 equity to debt. The sectors are IT, it's an heavyweight on IT, 12.5%, banks, finance, pharmaceuticals, so on and so forth, right? So you get to know exactly, where your portfolio is, what your portfolio is doing, how it is investing, where is it investing, what is the asset allocation, and the overall sector mix. Then what we can look at is the performance of the fund portfolio, right? What were the, so let's say over a period of 10 years, what were the cumulative returns, what were the CAGR returns comparing to a benchmark, right? So as we already mentioned, it is very important to look at the benchmark of compare with the right benchmarks. So let's say we are comparing this with the benchmark. So if you look at the equity market cap allocation, so we have 21% into mid caps, around 30% into large caps, 21 into small caps, and there's others around 24%. So it's a proper multi-cap kind of a portfolio, investing into large, mid, and small, and even debt category as well, right? So accordingly, we take the right benchmark. We compare, okay, in this fund, what we can look at is just on a CAGR basis. If you have to compare point-to-point returns also, CAGR in this case is point-to-point return. It is taking less risk than the benchmark. So if you see the benchmark volatility is 16%, the portfolio's volatility is 14%, and the CAGR is higher. So benchmark is giving a return of 15%, the portfolio is giving a return of almost 23.5%. So better risk adjusted returns, which is also showing in the Sharpe ratio. So we mentioned, we looked at Sharpe ratio, how, what kind of risk you are taking for the, what kind of returns you are getting for every unit of risk. We looked at it that more than one is good. You see here 1.09. Sortino ratio 1.17. In the downside, it is doing even better, right? Which is again reflecting in the up and down capture ratio. If you look at the portfolio, when the market is going up by 100 points, this fund, the portfolio is going up by 108 points. So it is beating the market when it is going up. When the market is going down by 100 points, it is just going down by 68 points. It is beating the market in the downward trend as well. So protecting the downside, taken care of. Capturing the upside, taken care of. Better risk adjusted returns, taken care of. All the things are done. Capture ratio, so we looked at the capture ratio also, 1.58. Again, a very good. And beta is just 0.61. Right? We talked about beta, less than 1 is good, which means it is taking less risk than the benchmark. So a lot of times, we saw that, okay, high risk, high reward. But here you can see with controlling the risk also, good returns can be generated. High returns can be generated, right? Now we have looked at point to point. We learned about rolling returns. Important to look at that, right? So you see here, over a 10-year period, the CAGR, point-to-point return of this portfolio is showing as 23-24%. So you'll see a lot of people come and they sell you, mutual funds or the portfolio, sir, 24% return diya hai. This is the return, that is the return, right? But this is not the actual return that you'll get on the portfolio or anybody would have experienced. Only the person who would have invested on 1st April 2014 would have, experienced this return if he would have invested in lump sum. When we look at rolling returns, you see the actual picture that over the 10-year period, how this fund has done. Yes, in short term, the negatives are also there. But over a 5-year, if you have invested in this fund for more than 5 years, your minimum is 3.5, almost 4%. High is 24%. the average return is around 15.5%. So ideally, we say, 12% returns is ideal, you can expect from a mutual fund or your portfolio. If you do this, yes, your returns are actually beating your target returns. You are able to generate 15.5%, right? This is the returns, considering 80 to 20 asset allocation. So even when you have debt in your portfolio is able to beat the benchmark by a good margin, right? This is the, division of the returns, in which what percentage of the returns fall in which category, which range of the returns. So again, in 5 years, it is not giving any negative returns. 0 to 8% only 4% of the times, 8 to 12%, 19% of the times, more than 12%, almost 75% of the times, 75 to 78% of the times, the fund is giving more than 12% returns, or the portfolio for that matter. Okay. Portfolio overlap. We looked at the overlap. See the overlap. Not more than 20% overlap in any of the funds. The highest is 19. It's all coming in green. We have seen portfolios which have almost in a lot of funds 50, 60, 70% overlap. So you see, with limited number of funds, you are able to diversify your portfolio enough where overlap is less and your diversification is good. You see, in some funds there is even 0% overlap, right? 0%, 1%, 3% as well. This will only happen when you build a good portfolio with different category of funds, which can perform at different point of time, which shows in the correlation table as well. How the funds are related, how they're performing. Are they performing all performing at the same time, or are performing differently at different point of times? So you see, there are two funds which are not exactly have a very high correlation with the other funds, which means when maybe majority of a portfolio is going down, the other funds are maybe not going down by that much, giving a stability to your portfolio as well, right? So these are all the parameters you need to look at when you are doing the portfolio analysis as well. This is not for just one fund or a category of funds. It's when you build a portfolio. Always focus on building a good portfolio, the right asset allocation, the right amount of contribution. Another important thing is this allocation, the large, mid, and small market cap allocation. So a lot of times we see people say, "हाँ मैंने 30% mid cap में डाला हुआ," and they say because they have invested 30% in a mid cap category fund. But when you go and look at the portfolio of the mid cap category fund, you will see that it has some exposure into small cap, very less, and maybe some very less exposure into large cap also, right? Even a large cap category funds sometimes have a allocation maybe 10-20% towards the mid cap as well. And similar thing might happen with a mid and small cap fund also, right? So it is very important to know what is the actual portfolio market cap allocation, not just a fund wise allocation. A fund will have allocation in maybe 2 market caps or 3 market caps. A flexi cap has in all the 3 caps. So you need to know what is the overall market cap allocation of your overall portfolio. Is it meeting your target asset allocation or not? Okay. So yes, a lot of people are asking, how you can analyze funds. We'll just go to the website. So there's a website called Advisor Coach. Just give me a second.
So just bringing to that point that people say, okay, if we invest in direct plans or direct funds, we'll get higher return. So just selecting a good mutual fund and then investing in its direct plans doesn't mean that you will get supernormal returns. It is the whole science behind portfolio construction. That at the portfolio level, what is the asset allocation? What is a risk? What is core portfolio? What is satellite? How are you rebalancing the portfolio? And how consistently you are generating a good XIRR for long periods of time after being able to control the risk. So risk adjusted returns. So it's a myth that because I have now learned to select some good funds, I can just invest in their direct funds. And, I don't need any professional to manage my money, or I don't need any advice from professionals. There are a lot of webinars, lot of training programs, pushing people to be DIY. Okay, do it on your own. Let me tell you that I myself spent more than 2 decades in this profession. It's not, as simple as it sounds. There are professionals which spend hours to analyze all this. And then there's a science behind portfolio construction. Okay, so if you invest in direct plans, you will save that 0.5% or 1% or something. But you will have to do all this on your own, which at times it is practical, not practical. And even after saving that, there is no assurance that you will beat benchmark by very good margin, or you will generate a great alpha. So what you should focus on, do I have professional help? It's okay. They can charge me 0.5%, 1% or whatever. What is the return they are generating after their fees? So after all expenses, if the benchmark is giving you a return of 15%, okay, and your portfolio is generating 18 or 19%, after all cost, after all fees and everything, then this is what you should focus on, the net returns after cost. And if that net returns are much above than the benchmark, this is what you should focus on. Don't get carried away in that trap that only investing in direct plans will give you higher returns. Okay, to an extent, I have clients who said that we are happy with 12, 14, 15%. We are happy with investing in just benchmark or index. We are happy with index returns. When you can generate much more than index, by actively managing the portfolio, by controlling risk, by scientifically creating a portfolio, why should you worry about paying that 0.5 or 1% to a professional who is helping you, who's freeing up your time, doing all this research for you, and helping you generate a much higher risk adjusted return? So I feel you shouldn't get really worried about this. If post cost you are getting good returns and it is beating the benchmark, that is what you should focus on. And it's a myth that advisors only tell you to invest in regular plans. It is not like that. Advisor can recommend a regular plan also, and they can also recommend direct plans. So it's a myth that if you want to invest in direct plans, you have to invest on your own. It's DIY. It's not like that. Like, for example, Finovate, we are registered investment advisors. We help you even to make a direct funds ka portfolio. Whatever we would have otherwise got from the funds, you pay that fee to us directly. So we do recommend direct funds, direct plans. The fee you pay us separately. But there are distributors of mutual fund who suggest you regular funds. They get that fee from the mutual fund house to do all this for you. You don't pay them the fee directly. So it is okay. There is someone who understands your goals, who understands your risk-taking ability, who understands a lot of stuff, and then he scientifically controls, makes a portfolio for you. To do all that, he earns a certain fee. That fee you can pay him directly, or the TER is charged by a mutual fund and they give that distributor something out of it. So I feel that the whole thing, that you should not take professional advice and you should try to do everything on your own. I feel you should think 2 times before doing that. You will learn everything about fund selection, but portfolio construction, monitoring and constantly making it work and beat the benchmark is a lot of work. So instead of trying to do everything on your own, you pay that 0.5% to a professional, but tell that professional to do a better job for you and give you superior returns.
So, as rightly mentioned, it is very important to build the right portfolio. We have seen in a lot of examples, we see clients every day who are doing a lot of investments on their own. They feel that their portfolios are doing good, but which they are not actually doing good. And even by investing, in direct funds, they're not able to beat the benchmark, or even a regular portfolio, which, somebody would suggest by a proper construction, by properly, selecting the right funds and the allocation. So a lot of you will be what was our asking, the tools. So yes, here is a tool where you can look at. It's a free tool, which is available online, called as Advisor Coach. So here you can go and do a lot of research about mutual funds. So if you go on MF Research, advisorcoach.com is the website. You go on MF Research, you will see all the different parameters where you can go and compare your mutual funds. Even they have rolling returns as well. A lot of websites we have seen don't cover rolling returns. This is one of the very few websites, which actually shows you the rolling returns of a fund, which we today showed you is one of the most important parameters to look at when you are considering investing in a fund, right? You have various parameters, even mutual fund over portfolio overlap. We looked at the overlap also. It is important. You will get rolling returns. Which quartile the mutual funds fall in. Lot of things. Benchmarking. Everything is there. The only disadvantage or the limitation of this platform is that you are not able to build a portfolio and do the analysis of that. You can do analysis of category wise, fund wise, and all those things, but you will not be able to do analysis of a portfolio. For those, there are paid tools which are available, which cost maybe a couple of lakhs per year or something like that, which might not be very feasible for a normal investor to spend so much on. So yes, but yeah, this is a free tool. You can use it to do various research. You can go on, rolling returns versus benchmark. You can select the fund, what is the rolling period. You just do this, submit, and you will get the, exact rolling returns of the fund. Okay. So let's say we select 3 years rolling. We'll start looking at from 2019. So this is the rolling return analysis: average, median, maximum, less than 0, 0 to 8, 8 to 12. Where did the fund fall? Where did the market fall? How is it? Is it beating the market? Not beating the market? A lot of things you can get it from this website. So the website is Advisor Coach. You can do analysis of other funds also, debt, equity, everything. These are available. You can look at it, do your own analysis, do your own research. If you need any expert advice, we are also there. We can help you in doing the analysis of your portfolio. We do, I think, we check your portfolio on more than 10 to 15 different parameters and show you the results, exactly how your portfolio is doing compared to benchmark, or how you can improve your portfolio as well, right? So all these tools, yes, are available to you, but yeah, the limitation is for a portfolio, it becomes difficult to analyze that, okay, the allocations that you have done in the mutual funds, overall, when they build a portfolio, how is it doing? Is it doing good? Not? The limitation is that. But yes, you can do the mutual fund analysis.
I think some questions were that how do you know how your portfolio is doing? Like how to know that my portfolio is good? I'll say that like we said, look at the portfolio's risk, look at the portfolio's return versus the benchmark. So if your portfolio is generating returns more than the benchmark and the risk is less than the benchmark, then it means that you have a good portfolio and you should continue investing in that portfolio. That is a way for you to judge how your portfolio is doing. All this is like it sounds pretty easy, but there's a lot of science and art behind this. So I think a lot of people are asking, okay, how do we analyze our portfolios? I think there will be links sent to you. You all can register or book a session where we will help you, just give you analytics of your current portfolio, that how is it on risk and how is it on return versus the benchmark. People want to know any site which mentions that what stocks the mutual fund has bought. I think every mutual fund themselves will be publishing their portfolio. If you can, Sagar, very quickly show them how they can know the portfolio of a mutual fund, which fund they have invested in. I think this is a very important session on how to select a mutual fund. We tried, covering a lot of things here. We've overshot the time also because this was a very vast topic. If this was of very interest to you, in the subsequent sessions, we'll like split this into smaller topics and bring about some more focus sessions on this.
So usually mutual funds, they publish their monthly fact sheets in which you can go and check the exact portfolio of the mutual fund also. I'll just try to find one. Give me a second. Yeah. So I went to the ICICI website. I searched, let's say, banking and financial services fund. I want to know about this. So there are a lot of information available here also. Fund performance, returns, performance table, lot of things. Even the mutual fund companies do a lot of, tell you a lot of things about the fund. So you can do sector and the holdings also. So you will see all the holdings which the mutual fund is holding on their website itself. So here you can check exactly, they are investing in HDFC Bank almost 23%, ICICI Bank 19%, Kotak 6.5%. It's being a banking and financial services fund, so yes, heavy on banks. So similarly, you can go to the mutual fund websites. You can look there. There are other websites also which show you the stocks which are mutual fund investing into. Your popular website like Money Control and all also are there, which you can go and look at. But usually we have seen that these are really updated. The mutual fund companies' websites, you can go and visit them and look at them and do some basic analysis of the fund. Advisor coach will also have some way, where you can look at portfolio overlap. So you can go and just check that as well. Also, we have been doing the series of webinars continuously. So people who want to, get added to the WhatsApp group where we keep posting about the webinars, you can also, scan this WhatsApp, QR code. So you will can get joined. I think we'll also post the link on the chat. You can use that as well to join as well.
So every Wednesday after Wednesday, we are bringing very important topics of personal finance. And I think till now, you would have figured out that these are very unbiased sessions. We are not biased towards anything. We are bringing you genuine information as it is. Like as finance students, as people who have been in the industry for more than 2 decades, what we have learned, this is what we are trying to bring to you in these webinars. So I would say that please forward these joining these groups to your friends and to your family if they have interest in personal finance and they want genuine education or not a biased kind of an education, then you can take the link and you can spread it amongst your friends and family, because Wednesday after Wednesday the idea is to we are not finfluencers or we are not any kind of influencers. We are people who manage hard-earned money of people. Okay, and so we have to be extremely careful in the way we manage people's money, and that very genuine information, what we do when we construct portfolio, how do we research, what thoughts go behind, when we are making a financial plan or we are doing investment planning, that we are bringing to you. So I would just say, okay, please spread this as much as possible, and you can take this information to your friends and family. I'm very sure it will be beneficial to them the way it is to you.
Great. So what we'll do is we'll sum up the session. Thank you everyone for joining. It was a nice and interactive session. I hope we were able to deliver some good, pointers to you, which will help you in analyzing your mutual fund portfolios. All the best, everyone, and good night from my end. Thank you so much.
Thank you so much for all the encouraging feedback which we are getting. I guess 70% people have given the highest rating for today's webinar also. So thanks a lot. And thank you so much to the entire FinnOvate team, particularly Sagar, for such high energy, even post 9 o'clock at night, and really compiling all this information together and delivering it so well. And once again, thanks to Vandana, because she's always behind the scenes, but puts in a lot of effort to really create the flow of these presentations very well. And definitely Pranav and Sakshi, without whom this all would have not been possible.
Thank you, everyone.